government just handed down the biggest shake-up to the property tax industry in nearly 30 years, and most investors are doing one of two things right now. Either they're panicking and sitting on the sidelines, or they're charging at new builds like it's the only option left. Well, both are wrong. There is actually a third path. And in this video, I'm going to walk you through the exact blueprint we are using here at Handle Properties right now for our clients in today's market. So let me be precise about what's actually changed, because most people are going about this the wrong way. I'm going to pull up the actual budget documentation today because I want you to read this directly from the government's own website. It's not my interpretation, it's the government's words. Investors who buy established housing after budget night will still be able to deduct losses against their residential property income. They will be able to carry forward unused losses to future years, but won't be able to deduct them against other income like wages. Well, there it is, straight from the budget. If you buy an established property after 12th of May 2026, any rental loss you make cannot be offset against your salary. It gets quarantined. You get to carry it forward, and it can only be used against future rental income or your capital gain when you eventually sell the asset. Now, the CGT change is on the same page. The government says it'll replace the 50% capital gains tax discount with a discount based on inflation and introduce a minimum 30% tax on gains from 1st of July 2027. Two changes, both from 1st of July next year, both applying to established properties bought after budget night. Now, the exemptions, because this is what most coverage is missing. Existing properties, including those already under contract before announcement, are grandfathered and can continue to access negative gearing under the current rules. Eligible new builds will remain exempt, with investors still able to access both negative gearing and the 50% CGT discount. So the government has created three tiers of property. You've got your pre-budget stock, which is fully protected, new builds, which are fully incentivized, and post-budget established property, the old tax model no longer applies. Most investors are panicking about tier 3, but the question you should really be asking is, do you even need to be in tier 3? Here's the thing about negative gearing that nobody wants to say out loud. It was never a wealth strategy. It was a cash flow subsidy for a poorly selected asset. You lose money every week, and the government gives some of it back at tax time, and you hope that the capital growth covers the loss. Well, that is not a strategy. That is a bet with a tax refund attached. And if you want to know who this actually hurts, well, CBA's own economists did the analysis. The effect is largely investors with very large marginal tax rates, extremely high leverage, and low rental yields with high interest expenses. Well, high marginal tax rates, high leverage, low yields, and high interest expenses. Well, this is not a description of well-structured investment philosophy. This is a description of an over-leveraged position being held together by a tax refund. The investors who are not worried right now are the ones who are never in that position. They were buying on fundamentals, things like population growth, supply constraints, and rental demand, and of course, long-term capital growth. The tax treatment was just a bonus, but not the business case. Now, here is where it gets genuinely interesting. The same government that removed negative gearing on established property is also making the supply problem dramatically worse. Now, let me pull up the latest ABS data. The total dwellings approved fell 3.4% to about 16,000 dwellings in April. And the month before, in March, it fell 10.5%. So 2 consecutive monthly drops. Now here's what that number means in context. Annual dwelling approvals have stalled, with about 200,000 dwellings approved in the year to February 2026. Dwelling approvals were 77,000. That is 19% below the target during the first 20 months of the Housing Accord. 196,000 approved, 240,000 needed. So that's 43,500 homes short every single year. And of course, not every approved home gets built because construction costs are up over 40% since COVID, developer insolvencies are elevated, and the council estimates about 980,000 new homes could have been expected in the accord period against 1.2 million. So that's still 220,000 homes short over 5 years. Less supply, Now, budget changes reducing investor appetite for established stock, with 300,000 people arriving every year who all need somewhere to live. Now, what does that environment do to well-selected property? It's going to push it up. The budget changed the tax treatment, but it did not change the laws of supply and demand. So here is the exact blueprint. Step 1, select on fundamentals, not tax. The property decision comes first. Suburb, supply dynamics, vacancy rates, population growth, infrastructure. Then your accountant works out the structure. These are two separate conversations. This means the change is designed to risk investor demand for existing housing stock while preserving tax support for investment in new supply. Designed to reduce investor demand for existing housing stock. Now, that is the government stated intent, which means established property bought right in the right suburb now has less investor competition. That is the window. Step 2. Target cash flow neutral or positive properties. Investment loans are now sitting between 6.5 and 6.7%. So therefore, with a 20% deposit, you need a gross yield of at least 5.5% to approach neutrality at those rates. Now, that does not simply exist. Not all properties will achieve that. And here is the critical point on quarantine losses. In the event the rental losses exceed the above income, the losses can be carried forward to future years. Your losses do not disappear. They compound forward and offset your future gain on sale. The tax refund is simply delayed, not eliminated. The difference is cash flow timing, not total return. Step 3, structure before you sign. The entity you hold your next property in matters enormously under the new CGT framework. Trusts, SMSFs, personal names, different outcomes apply post-2027. There are transitional arrangements in place for gains arriving before 2027 subject to the current CGT discount. Now talk to your accountant before signing anything. Step 4. Hold long enough for supply to do the work. Now, we are short 43,500 homes every single year, and that gap does not care about sentiment, and currently around 18% of new investor finance approvals are for newly built homes. But of course, this is probably going to rise towards 40 to 50% as per Westpac's projections. Now, a wall of money was already moving towards new builds, which means investors who want established stock are competing with fewer buyers, not more. So 3 things for you to do this week. 1, audit your current portfolio. If you own properties before budget night, well, you're grandfathered. You have a structural advantage over every new investor entering the market from here. Do not sell until the fundamentals of the asset itself have changed. 2, get this tax structure conversation happening now. Not in 2027 when the rules kick in, but now. Talk to your accountant before you sign anything. 3, stop waiting for the market to bottom. The window where established property has less competition and softer sentiment is not permanent. It closes when the rate drop or when the next data point shifts confidence. The question is whether you are positioned before that happens or after. Handle Properties, we're a Sydney-based buyers agency. We source off-market investment properties across the country for clients looking to build long-term portfolios. We evaluate every suburb across more than 30 plus data points before we even recommend it. Our clients don't rely on tax policy to make their numbers work. They rely on the fundamentals. So follow us at Handle Properties on Instagram and YouTube. And if you liked what you heard today, book a strategy call with me and we'll go through your individual portfolio.